Answer this question for yourself. Do you want the central banks to have the ability to just at will? I don't. I want to be able to say to them, too bad, so sad. What you do, it's going to impact everybody.
Hey, financial thrill seekers. Brace yourselves as Treasury Secretary Yellen's soft landing recession claim kicks off market mayhem. With the Treasury borrowing a whopping $776 billion and the Fed unloading $95 billion monthly, we're in for a wild ride. Why does it matter? Hold on tight for potential interest rate turbulence and the looming risk of a financial shakeup. Spot gold is already on the rise. Join Lynette Zang till the end of the video to uncover why this matters and how a Fed pivot could stir up inflationary chaos. So let's listen to her again.
Because now, forget rates, now worry about the Fed unwinding its balance sheet, which means the Federal Reserve selling $95 billion worth of treasuries and mostly treasuries, but treasuries and mortgage-backed securities a month. Discussions come as funding markets showing signs of angst. Wow, okay, do you remember 2019? Because I sure do. They tried an unwind before. The last time the Fed attempted a balance sheet reduction in 2019 and the funding markets prompted a rethink. You think? Of course, because Fed printing is all they have. That's the only tool that they have. And so that is what's creating artificial liquidity in the markets. And when you take that away, there is no liquidity. So that's what happened in 2019. And you can see that this is where they are dropping their balance sheet. Now, they're still very close to $8 trillion in holdings on their balance sheet. But look at this. These are the deposits held by depository institutions. So those are going up a little bit because I guess March last year wasn't a big enough of a warning to say, don't keep your money in the banks. So, okay, let's forget that. I'm getting more interest, so risk your principal. Makes no sense to me. The Treasury account itself is up, but what's down? Reverse repos, right? And the reverse repos are the collateral. The treasuries, rather, are the collateral for this repo market, which is the underlying plumbing of the global economy. And a lot of that also comes from money market accounts, which most people think are so safe. Well, are they? I think it bears a rethink. Fed's balance sheet leaps into spotlight after repo volatility because their attempt to run off the balance sheet led to the 2019 crisis. Now, they covered that up really quickly like they try and do just what they did last March when the banks started to implode. They covered up really quickly, nothing here to see, just keep moving, just keep your money in the system so that when they finally bail in all of the debt-based assets, what are you going to do about it? You want to be preemptive. That's the point of gold for wealth preservation. This is what I use for my personal wealth preservation because it's out of the system. It's real. It has more functionality than any other asset class, and it runs no counterparty risk. Everything else is all counterparty risk. Okay, so the use of reverse repo facility fell by $313.6 billion on Tuesday. Traders look to this tool for clues on the quantitative tightening path. You gotta pay attention to this stuff. So this is the use of the Fed's RRP, reverse repo facility, fell. And look at how far down it's gone and look at when it started to come up. It is down at 1 trillion from well above 2 trillion. Okay, you say, well, isn't that okay? Well, maybe, but Wall Street strategists have estimated balances at the RRP facility will be completely depleted by the end of the second quarter, at which point, this is important, at which point the central bank will be compelled to halt quantitative tightening. In other words, they will not be able to run off their balance sheet anymore. And what happened in 2019 and that forced the Fed to go back in and boom, stimulate, there's your hyperinflation. And we've already seen that that's begun in the monetary velocity that I just showed you, I believe it was last week. The third largest right now is the third largest start of the year outflow since the facility was introduced in, when was that? 2013. And what did we see in 2013? I didn't put that graph in this one. I've used it so many times. But you look at the volatility on the 10-year Treasury, and that's when it is quite clear that the Federal Reserve handed over control of that market to traders that are just looking to make a little bit of money. They don't care about the stability of the markets. The Fed will have to stop its balance sheet runoff before the reverse repo facility is entirely drained. At the same time, that money market fund assets rise to new all-time highs. So, I mean, you're running into the chicken coop and the foxes are holding the door open and they've got a whole band of foxes in there. I'm telling you, as a chicken, I'm running to the safety of gold. I'm not running into the chicken coop, but a lot of people are. Total climbed to 5.965 trillion. And the sad part is people think that these are safe. But there were a number of people in 2008 that learned that money markets are not so safe. So they changed the rules, making it harder for you to liquidate your money markets. That was the solution. And they drained a lot that was going to corporations. The government drained it into prime accounts that have government debt on there. But that's the public. We already know, I've done videos on this recently, where the long-term holders that don't really care about price fluctuation are getting out of the market, including the Federal Reserve. That's what we're talking about here today. And the public is getting in. Voila, that's what we're talking about here today as well. And you can see this goes back to 2020 with the big spike into interest rates. But government funds, which invest primarily in securities like treasury bills, repurchase agreements, and agency debt, saw assets rise to 4.878 trillion. So you think you're safe in government funds? You know, there is this bridge in Brooklyn that I'd love to sell you. Because you believe this, you're going to believe that. The markets in general sees the Fed's exit from quantitative tightening nearing, which is why you see interest rates dropping down and therefore short-term bond values, market values going up. That's why you see the markets. Markets have been very volatile, but the markets have been going up. The problem is that all of those pieces of Wall Street intangible crap is all based on this. Well, this is my funny money, but basically based on dollars that are also losing value via inflation. I mean, you're experiencing inflation. Is that because those things that you're buying are worth that much more? Or that the dollar is worth that much less? That's what it's about. And that's the only thing they have that at their disposal, right? So now, hey, interest rates are up, 5.5%. The Fed has room to drop them down. So they broke the broken market that they created. And then they're going to go bail it out again. Well, it only works so many times. Volatility has erupted again. Gyrations in repo rates sent one benchmark to a record in the past week, while the market for short-term loans collateralized by treasuries fluctuated, which means went up and down, up and down, up and down because of that volatility. In fact, volatility in short-term funding markets can hinder central bankers' ability to manage monetary policy. Oh my goodness! Don't worry, we'll let them bring out the CBDCs, the central bank digital currencies, and what do they say? We can have our finger on that button 24/7. You are going to be so off balance with anything they're doing unless you have food, water, energy, security, barterability, wealth preservation, community, and shelter. You need to get those things locked in. Do you answer this question for yourself. Do you want the central banks to have the ability to just at will? I don't. I want to be able to say to them, too bad, so sad. What you do, yeah, it's going to impact everybody. I'm not going to be immune, but I'm going to be more immune because I have especially the only financial asset that is completely outside of the system and runs no counterparty risk. None. But do you think all of this volatility and potentially those massive, higher than they can expect interest rate spikes, will that force that Fed pivot that the markets are demanding? Who do you think is stronger, the central banks or Wall Street? I guess we're going to find out, aren't we? And all of this, is that why gold is breaking out? And I'm talking about spot. I'm not talking about the real thing. That broke out a while ago. So let's look at this spot market because remember, we've talked about these different toppings, right? 1, 2, 3. 3 tops. A fourth is 3 is a lot, right? Where it goes up, it hits its head, and then it comes back down, goes up, hits its head. So that's what they're attempting right now, is to further push it down. But the way that it works is really simple. When you have a spring, and that spring is held down, so the spot price on gold is held down. When that's released, it shoots in a direction. And that's what it's been doing. And I would consider this, now this I would not say is a pervasive breakout yet, but I would say that that is imminent. So this is probably your best and least expensive time to position into this. Therefore, in this year, I expect much higher spot gold prices. And no matter what happens with spot gold, because remember, a rising gold price is an indication of a failing currency. And so it benefits central bankers and those that are in power to suppress that spot price. But in the physical only, this is physical only market, we have seen at the upper echelons making way new highs. And even in the area that I personally buy into, still making this trend new highs.
Well, that's a wrap on our financial roller coaster journey today. I hope you found this exploration enlightening. Remember, the twists and turns in the market are opportunities for informed decisions. If you enjoyed the ride, don't forget to hit that like button, subscribe for more insightful content, and ring the notification bell to stay updated on our financial adventures. Feel free to share your thoughts in the comments below. What's your take on these market maneuvers? I love hearing from you. Thanks for joining us on this ride, and we'll see you in the next one.